Well, folks, Cathie Wood is out with a brand new video, and we're going to go through this. We're just going to go through the first 17 minutes of this video. We're about 16 minutes, actually. I'm going to give my opinion, and the reason that's all we're going to go through in this video here is essentially then she starts getting into fiscal policy and economic policy, things like that. What I'm really here for, and I think what you guys are here for, is what does she have to say about her stocks? What does she have to say about her portfolio? Is she confident? Is she not confident? What does she think is going on out there? I think that's why we're all intrigued, and probably why you clicked on this video, is to find out, what she's basically saying here, in my opinion, on this. And if you haven't seen, guys, I mean, the ETF is down almost 71% from the highs now. 71%. I mean, that's extraordinary if it's a stock. This is an ETF. You don't usually see ETFs down 71%. Like, that's absolutely extraordinary. Obviously, Cathie Wood's been hurt pretty dramatically, from my understanding, is she has had some inflows of money recently. Now, there's a possibility that during this video at some point I blow away and the whole garage blows down, okay? It's talking about 65-mile-an-hour gusts, but I'm telling you, 65 is a joker, okay? I think it's like blowing like 80 plus when it's wind gusting out there. So there's a possibility that at some point during this video, the garages just blow off. Okay, so anyways, hope you guys enjoy this as always. Let me know what your opinion is on anything we talk about in this video. Also, check out FTX US. That'll be first link in the description down there. Get up to $100 in free crypto with your first trades through the platform. Get a free coin with your first trade over $10. Use Holy Smokers as your referral code. Let's get into this.
It's been a very tough month since we last gave this webinar, but I wanted to, first of all, thank you very much for your support. ARK is net inflowing this year. And I think it's because...
That was a somber start, but she's saying ARK's net inflowing, she's saying.
We give away our research, and our research is unique. It's original research. And we are trying to help people understand how the world is going to change during the next 5 to 10 years and how rapidly it's going to change. And I believe that our comparison to the NASDAQ 100 has also helped. The NASDAQ 100, according to our estimates, is exposed to truly disruptive innovation to the tune of about 25%. The rest of it is names you know very well: the FANGs, Microsoft, NVIDIA, and the sundry food and rail and trucker companies. ARK, as you know, is focused solely on truly disruptive innovation. And most of our stocks are not in broad-based benchmarks. And I believe people who are reading our research...
That's accurate. Most of our stocks are not in broad-based, benchmarks. But one thing, let's just address this. I think it's very, very important. We got to address the elephant in the room here is, how many of Cathie Wood's companies necessarily do we fit that criteria of super innovative, right? Obviously, you got Tesla as the biggest position for her. Usually Teladoc's up there. Now, Teladoc, I've done a lot of research with T-Doc, and, I actually kind of like the name, and I've been thinking about getting in it. I haven't bought yet. But I've heard, I've talked to a lot of people, and a lot of people are kind of like, it's not that innovative. Zoom's one of her biggest positions. That's usually a top 3, top 4 position. Zoom, a lot of people feel like it's just a glorified business FaceTime. Like, what's special about that? Have they built anything else? So you start going through these positions, Roku, and I mean, once again, it's in the eyes of the beholder. Cathie Wood looks at these companies and says they're highly innovative. They got tremendous growth opportunities over the next 5, 10 years. Other people look at them and they're like, big deal. Like Zoom, like, come on. Like Roku, that's the way some folks think. So as many things in life, it all comes down to it's in the eyes of the person that's making that judgment, right? She feels they're innovative.
Advisors, investors are beginning to understand that they don't have enough exposure to those companies and those stocks that are going to cause transformations in the way the world works. So we thank you for your support. This has been a very difficult time for everyone. As you know, we've always considered ourselves the closest you'll find to a venture capital fund in the public equity markets. And as we all know, venture capital funds have a 5 to 10 year investment time horizon. Our investment time time horizon is 5 years. And we couldn't be more optimistic about how these new technologies are evolving. And the reason they're evolving more quickly than we anticipated is because we have many more problems than we anticipated. I certainly didn't anticipate the magnitude and length of time that we'd be facing supply chain issues. And I certainly didn't anticipate Russia's invasion of Ukraine. So we have...
It's interesting. Both those statements, around supply chains there, and even the statement around kind of the Russia situation, like both my mind came back to one stock immediately, and it was Palantir. And if you didn't know, Cathie Wood they sold out of Palantir a couple months ago. And so... yeah, I mean, since that time, by the way, Palantir stock price has gone down, but to be honest, it hasn't gone down nearly as much as many other stocks in the market. So yeah, I find that interesting that she brings up that. And first thought process I went through is, Palantir, I remember, and she sold that one, right?
More problems that innovation will help to solve. So just wanted to start with that note. And before I go into monetary policy, fiscal policy, economic indicators, and market indicators, and end with a little bit more on innovation, I'd like to compare what we've been through the last year or so to what we went through right before COVID. So from February 20th to March 20th, our portfolios, our strategies, the performance, they were cut in half nearly. And it was in 1 month span as we thought the world was going to shut down, and we wondered about a depression and a collapse in many other ways. And at that time, we began to analyze the economy, or scrutinize every economic indicator that came out for clues as to what really was going to happen, how successful.
Before she kind of goes on here, I want to make one point here, because she obviously just referenced the March of 2020 crash when the S&P 500 went down 35% in 22 trading days, the fastest fall in stock market history to fall that much, that fast. One thing I want to say first off, I think this is obviously very, very important for everybody watching this while the tornado goes on out there, essentially, is think about from this standpoint, right? Everybody, that comeback was fast. After we bottomed, it was around March 23rd, if I recall, of 2020. After we bottomed, the market came back fast. I mean, really, really fast. And it blew everybody's mind, including myself. I didn't even think stocks were going to come back that fast. And I mean, they just rocketed up. Now, what a lot of people will say is that's because the Fed, right? The Fed stepped in, they put the money printer on and all those sorts of things that everybody likes to say, right? In this situation, everybody feels pretty confident that the Fed's going to work against the market for probably this entire year, right? So they feel like there's no magic Fed coming to the rescue or something like that, right? And the Fed can change course, but can the Fed really change course to going from we're raising 50 basis points to all of a sudden we're cutting rates, right? In a period of 6 to 9 months. And that's what a lot of people are like, I don't know about that. So that's why a lot of folks are looking at this, right? And they're not convinced that a lot of stocks are going to come back fast. They're not convinced that the ARK ETF is going to come back fast. A lot of folks are saying this is going to be a long, drawn-out process that's going to take potentially years, right? Some people feel like some of these stocks will never get back to those prices. And, I'm not going to get into that whole debate, right? But some folks say Teladoc's $30 something today. It's never getting back to 300 is what some folks say. We'll see as time goes on, obviously. But I think that's just kind of very important because I know, a lot of folks are expecting magically just stocks to skyrocket, and sometimes you got to let these things play out a bit, and it takes a bit of time.
The stimulus policies being. And as you know, we started this webinar series or YouTube series. At that time, every week we were trying to reassure people that, especially investors, that the world was not ending, that it did seem as though the global stimulus measures were going to work. And we also at that time started our mantra, innovation solves problems. The coronavirus crisis created a lot of problems, and innovation, whether it was in the genomic space, testing, vaccines, or in the workspace, the hybrid, actually the remote work and now hybrid work. These were solving the problems of that day, and they're continuing. These are trends that have been unleashed and are unstoppable now. So now we are a year into a similar time period. The performance of innovation-based portfolios has been crucified, even though the number of problems that have cropped up in the last year have given innovation even more opportunity to perform.
Yeah, she's talking about some of these stocks have been crucified. And I mean, to be fair, you look at some of these stocks, like for instance, Teladoc, TDoc, and Zoom both come to mind. Those stocks are actually much lower today than they were prior to Rona. Think about that for a second. Like, that's crazy to think about. Those companies got a massive boost, right, for their businesses that are long tail benefits for years and years to go in the future. Dude, it's crazy out there. That's all I'm going to say. I don't even know if you guys can hear that. It's out of control out there right now. But anyways, I'm trying to keep my focus in this video. A lot of those stocks, I'm risking my life, man. I think I need to build a tornado shelter. This is out of control. But a lot of those stocks are lower today than they were prior to Rona, and that's just nuts to think.
Because we did so well coming out of COVID, again, our companies were really helping to solve problems. We have faced in the last year the so-called comparison issue. Now, we have a 5-year investment time horizon, so we're not looking at year-to-year comparisons. Nonetheless, the markets got caught up in, oh dear, how much slower is it going to get? And so we've been grappling with the consensus Wall Street expectations year over year, and their worries that growth rates would continue to slow down into negative territory, much like they did during or in the aftermath of the tech and telecom bubble. We couldn't be further away from the tech and telecom bubble. The innovation that was accelerated during COVID is continuing apace, and I will go into in a moment what our expectations are for revenue and margin growth during the next few years.
So she's basically saying here that, you know, what we're going through right now, although the price performance of many of these stocks are getting hit like it was a tech bubble, right? Because if you remember when the tech bubble, let's call it popped, countless stocks went down 70, 80, 90%. What do we have right now? Countless stocks down 70, 80, 90%. Everything from huge companies like Netflix, for instance, to much, much smaller companies and small caps and mid caps, right? I mean, the amount of stocks I know of personally that are down a minimum of 60%, right? But probably a lot more than that. It's a long, long list of stocks nonetheless, okay? And so all I'm going to say here in this situation is, the price performance has been exactly like what happened in the tech bubble. But what she's making a point of is the fundamentals of this market is not the same as a tech bubble, and the fundamentals of these companies is much stronger than back in 2000, 2001, 2002 when that whole situation went on. So she's going to get into more here.
What are some of these problems? Well, we see labor shortages still. And in fact, we're beginning to see labor hoarding. We see companies now taking on labor when GDP has gone negative. They went through such a difficult period that they decided, oh, heck, I'm able to get this person now. Even though my business is slowing down, I want to make sure that I never go through that again. So I think we're seeing labor hoarding, much the way we saw inventory building when manufacturers and retailers couldn't get the supplies they needed as consumption of goods, non-durables and durables, took off during the coronavirus. And so I think for both reasons, we're seeing a margin squeeze broadly in the economy, and we will continue to see margins going down. Well, innovation solves those problems. You can automate more to solve for labor shortages, automate more to solve for inefficient processes. Robotic process automation is really evolving very, very quickly. We're seeing supply chain issues because of China's now zero COVID tolerance. They came on very strongly this week. saying that was Xi Jinping's top priority. And they did not mention growth in the economy as another priority. So they seem to have toughened their stance. So these supply chain issues will probably continue. And we believe that automation and workarounds, thanks to technology, are going to help there as well. We see, because of Russia's invasion of Ukraine, food prices soaring, energy prices soaring. Well, electric vehicles are, we believe, starting to take the edge off of that. There's been an accelerated shift in consumer preferences towards electric vehicles. And so that we believe longer term will pull energy prices back down. I know I've been on record saying that energy prices are going to plummet back down to where they were in the 70s, we believe, longer term.
Wow.
Because the move towards electric mobility is unstoppable, and it is now happening at an accelerated rate.
Okay, so the tough part of that is, remember, when we're talking about energy prices, and I just want to push back against what Cathie Wood just said right there. Remember, when we're talking about energy prices, we're talking about supply and demand game, right? And so, I had I think a professor made this statement a long time ago. And, even back then we were talking about like electric vehicles and the future of energy and wind and solar and things like that. And he, this gentleman, one of my professors, he was basically saying, it's just because things trend that way does not mean oil's going to be like a free or like super cheap or something like that. Because he said at the end of the day, it's a supply and demand game. So they could just cut supply. OPEC does this stuff all the time, right? Oil producers do this stuff all the time. If price drops, what ends up happening? Everybody ends up cutting supply until there's a place where demand outweighs supply, and you can obviously get the price up, right? And so that is something to remember here in this kind of whole situation. So, I mean, I don't want to say forever oil price, gas price, things like that will be let's call it high, but at the same time, to predict like the prices are going down to the 70s levels anytime soon, it's a tough prediction to make outside of a massive recession or something like that, right?
In terms of food prices going up, well, Ukraine is the breadbasket of Europe. And so we have to use genomic methods, gene editing in particular, to be able to plant in less fertile areas. And that work is underway and proliferating as well. So what I'd like to do is talk a little bit about what has happened in this last year, and especially in the last two quarters. The risk-off period that higher interest rates and inflation have caused has forced investors who have been risk off, don't have as much tolerance for risk as they once did, to diversify back to their benchmarks. That they have done, we believe, and in so doing, they have sold our stocks. Our stocks are not in benchmarks, with the exception of Tesla in any great measure. And as you'll notice, Tesla has held up much better than other of our innovation stocks. It's because it was put into the S&P 500 and other indices in recent years. Actually, S&P was in late 2020, and since then it has held up better. So we believe that our technology holdings are the technology and innovation holdings that will serve the future. And in contrast, the S&P 500's exposure to technology is 28% of that index. We don't own any of those stocks. We do not think that technology stocks in the S&P 500 are going to participate in the true transformation of the global economy in the next 5 to 10 years. What has happened also, algorithms and quantitative research directors and analysts understand that this is what happens during risk-off periods, and so they have helped to exacerbate it with their algorithms. So what we're going to do to help people understand what is truly going on out there and how the world is going to look, not how it has looked, which is what the benchmarks are all about.
Based upon the way it sounds outside, doesn't sound like it's going to be good. World does not sound safe. That's all I'm going to say.
Publish a paper which addresses head-on the criticism that ARK's portfolios and the companies in the portfolios are really just a repeat of what happened during the tech and telecom bubble, which, as we know, did not end well. Well, that is how those algorithms and quantitative experts have been treating our strategy. And the similarity in terms of footprint to NASDAQ 100 circa 2000 is quite similar. So we want to establish now how different the fundamentals of our companies are relative to those that were birthed during the tech and telecom bubble. Those were seeds, and many of the seeds failed. If you look at the NASDAQ, they won't even publish what their holdings were in 2000, 2001, or 2002, or 2003. We tried to get hold of those companies. They won't show them because so many failed. So we had to resort to NASDAQ 100. And, of course, there's survivorship bias there. The largest companies had a much better chance of survival. Nonetheless, with the NASDAQ 100, what we have discovered is that the revenue growth of the companies in the NASDAQ 100 peaked around 99, 2000, and then moved into negative territory by 2003. Now, if you look at our companies, we are seeing revenue growth. Even if you use consensus estimates, not ARK's, consensus estimates, the same.
This is good, in my opinion. This is good. Finally, she's not talking around circles. I like this part here.
Analysts who are recommending whether or not to allocate more to benchmark related stocks or our kind of stock, they are suggesting, or their estimate for the next 2 years for our revenue growth, the revenue growth of companies in our portfolio, is in the 25 to 30% range. Now, our expectations are higher than that, but that is that's a long way away from negative. That's the first thing. The second is, if you look at the gross margin structure of the companies in the NASDAQ 100 circa 2000, you'll find that the peak in the gross margins back then, and gross margins are a really good, give us a good idea of what underlying profitability is and will be. So gross margins slipped from the high 50% range to the high 40% range as revenue growth was declining. The consensus view for the stocks in our portfolio for the next few years is that our gross margins will move from the mid-50s into the high 50s. And our expectations are that they will be closer to the high 60s. So very, very, very different time compared to the tech and telecom bust. Our revenue growth remains robust. Our gross margin structure is increasing. And in fact, if you do compare the lines at the similar point during the tech and telecom correction, you'll find that our margins have just moved above those margins. Many people criticize our portfolios for the lack of earnings, and many of our companies have very fine earnings, but many companies including those with fine earnings, are investing aggressively now in sales and marketing and R&D to make sure they capitalize on some of the biggest opportunities of our investment lifetimes. Now, I've been around in the business for 45 years, and I've never seen the opportunities I see now. According to our expectations, truly disruptive innovation, which right now is valued in the global public equity markets at roughly $10 trillion, roughly 10% of the global equity market cap. We believe that 10 trillion is going to scale to 210 trillion by the year 2030. And if you want to see the building blocks that make up that analysis, take a look at our Big Ideas 2022, where we size the opportunities that are evolving thanks to genomic sequencing, robotics, adaptive robotics, energy storage, artificial intelligence, and blockchain technology. The paper that I just referenced, we are going to be putting on our funds website sometime within the next 2 weeks. So we'll invite you to take a look at that. Night and day compared to the tech and telecom bubble. Okay, now on to, and I might add,
hold on.
Valuations of our companies now, if you look at them from many different angles, are below those of the NASDAQ. And as I just mentioned, we do not believe that the NASDAQ, certainly not the NASDAQ 100, includes nearly enough disruptive innovation opportunities as our strategies do.
Okay, so she brings up a couple good points there that I want to pick out, okay? One is obviously the point of a lot of her companies will outgrow the average NASDAQ company. I agree. There's a lot of companies she definitely has in at least a main ARK ETF, and I don't want to speak on the other, because she has several different ETFs, but I'll just speak on the main one that everybody cares about, the ARK ETF, and you can see what stocks she holds on CathieWoodStocks.com. But when you look at that, there's a lot of those stocks, they're going to definitely outgrow the average NASDAQ stock over the next 5-10 years. And so that's definitely a fair point. I think another great point she brings up is, everybody likes to try to put this into the same category as a tech bubble. And the way the stock prices have reacted, absolutely, it has been identical to the tech bubble. But in the fundamentals, she brings up a great point. These companies are not the same type of companies back in that day. I can tell you that much, okay? You can make fun of some of these stocks or Zoom or whatever she holds, Spotify, Shopify, some of these different stocks they have, right? Teladoc. But at the end of the day, I can tell you these business models are a million times better than the business models that they had back in the, in the tech bust, essentially. Back in those days, a lot of those companies didn't even have revenue, okay? And the ones that did, it was minuscule revenue. We're talking like maybe, a few million a quarter, something like that, maybe 10 million a quarter. It was minuscule. These companies are doing, if you go through her portfolio, you're going to see a ton of those companies are doing, especially as far as like the top 15 holdings, you're going to see like those companies are doing like billions of dollars of revenue, right? And so I think it's totally a mischaracterization to try to put this time period we're going through and say, oh yeah, it's the same as the tech bubble, because it's like, no, these companies fundamentally are, massively better positions, balance sheet wise, and on the income statement wise, like not even, it's like night and day, okay? And so I think that needs to be said, okay? So anyways, I'd love to hear your guys' opinion on Cathie Wood, the ARK ETF. In my personal opinion, I've always looked at her ETF as kind of like, you could play it that way if you really don't want to worry about stocks, or you could just say, hey, this is 3 stocks or 5 stocks I like the best in the ETF, let me buy these, right? And you could always do that as well. So love to hear your guys' opinion in that comment section. As always, I made it through the tornado, and if this video gets posted, that means I made it through the tornado even to posting, okay? So I hope you guys enjoy this as always. Also, FTX US, check out first link in the description down there. No basically fixed fees on FTX, and get some free crypto as well when you start trading through FTX with my link and Holy Smokers referral code. Much love.